Whoa, did somebody get the license number of that truck? The market just took a beating a little bit on Thursday, but Friday got spanked. Here's the reason why: the bond market. Look at the collapse in the bond market, and remember that when bonds go down, yields go up. Interest rates is the total story here. Interest rates spiked on the back of a strong economy. Normally, bonds go down when inflation is coming back. But there really is no inflation right now. But nonetheless, the strength of the economy on the back of the unemployment number that came out at the lowest level, the unemployment rate, since 1969, spooked the market. Now let's tear right into it, shall we? Let's break it down. I'm sorry. Hi, I'm Courtney Smith. This is Wall Street Winners. This is a really boring disclaimer. This is the S&P. Now, the S&P, as you can see, on Thursday and Friday got hurt. It came down pretty hard. The purple predictor turned negative a couple of weeks ago. We talked about this last week. Now, one little bit of positive is the fact that the S&P did close off the lows. So there was late buying here. But that purple predictor is not good looking. Let's take a look at the Dow. Up at the top, we see that the buying pressure, the green line, is now basically equal to the selling pressure, which is the red line. In other words, we have a balance here in the Dow. Now, I drew this green uptrend line, which suggests that if this market continues lower, and I do think that it will, it might get down to 2610 to 26,200. In other words, there's not much on the downside still to go. So one of the things as we go through here, there's other bearish factors, but none of them mount up to a bear market. They mount up to a correction only. Let's keep going. The Nasdaq, though, was the one that got hurt the most. You can see it right here. We broke below the September lows. We never did make a new high above the August highs. Purple predictor actually is not so bearish anymore, so that is one positive here. But it was the Nasdaq that got hurt the most. Seasonality, this is a big thing. I had my seasonality flip indicator at 165. And I say bullish on here. I'm sorry, it should not say bullish on the chart. It should say neutral. When we broke below 165 and then broke below 164, that was a sign that the seasonal bullish period was over. So we're going then, that doesn't mean that we go into a bearish zone. Believe it or not, there is no bearish seasonality in the stock market. There's only bullish and neutral. But right now, we got to say bullish is over. So what does that mean? Well, what it means is that when it was seasonally bullish, all the positions I bought were at least 50 to 100% bigger than normal. Because if seasonality is bullish, that provides a tailwind to our stocks. And that has worked great. It has really helped us crush the market and humiliate our competition. But now things are no longer seasonally bullish, in spite of what it says on the chart there. They're neutral. So that means we pare back. We keep our 2%, our double size positions or 50% larger positions in our old stocks, but any new positions will just be a normal size position. Okay, that's the effect of this. Seasonality, though, look at this. We're, according to Stock Traders Almanac, we're just at the beginning of what should be a significant rally. According to Ned Davis, we're in a period of a significant rally. But Ned Davis's chart here, you'll notice there's a little sharp decline in the middle of October. Maybe that's what we're doing right now. Then we rally up to the early part of November. Then we get another sharp decline in the middle of November. So maybe all this is a 2 or 3% dip in a major bull market. I don't think so. I think we can dip a little bit more, but it's not going to be a bear market. Yield curve. Now, a lot of what people are talking about, I've been using the yield curve now for over 30 years to predict recessions with 100% accuracy. More and more people our understanding that the yield curve is a leading indicator of stock market crashes and recessions. And in fact, all stock market crashes and all recessions have been led by a year of a flat yield curve. Now look in the lower right-hand corner, and you can see we got down below 75. That is to say that 10-year Treasury notes yielded about 75 basis points, or 0.75% more than 3-month Treasury bills. Well, that's not a flat yield curve. A flat yield curve would be 0. But look what's happened recently, and particularly late last week, is the yield curve went up sharply. And this is one of the factors that tells me we're not going to have a crash. What we're seeing right now is not a crash. It's not a bear market. We're not going to see a 20% drop at all, period. Just banish that. Let all the doom and gloomers go completely berserk. I put out a financial crisis report that suggests if we're going to have a bear market, it's next year. If we're going to have a financial crisis, it's next year. It's not this year. Asset allocation. Now, this was interesting. We saw the bonds get crushed. I showed you that chart in the opening slide. They moved, when they sold those bonds, they bought stocks. So the stock market didn't crash as much as the bond market did. And as the bonds are leading this whole market down, that money is going out of the bond market and actually helping to support stocks. Now, a lot of it's going into cash too, but a lot of it's going into stock market and supporting the stock market. But as we've highlighted recently, the stock market participants want less risk. And you can see the RISKDICATOR drop sharply, showing that they're hunkering down. They want to buy utility stocks. And utility stocks are doing great right now as they are a safe haven for market participants. Global shares, they got hammered. Fortunately, we don't care about them. I showed you the bond chart. Let's look at our bond key factors. The green line is the T-note yield, and you've seen that if the yield goes up, that means bonds go down. The blue line is the key here. That's the key. That's the 10-year Treasury in Germany, which is a direct competitor with the U.S., and it's up sharply. What else is up sharply is look at the CRB. That's the red and black chart, and it's spiked, largely on the back of oil and other things. So the only thing that isn't supportive of higher interest rates is gold, which is that gold line, and it's just going sideways. But everything else is saying higher yields. The dollar, oddly enough, was not really affected by the high yields in the United States. I think at this point, best to stand aside. Gold also was not affected by the higher yields. Normally, when you have higher yields, you should see gold go down because it's more expensive to hold gold when interest rates go up. I actually think this is pretty bullish price action for gold. You see, when there's bearish news and the market doesn't go down, that's bullish. I want to be a buyer if it breaks above 1220. That yellow line is slightly slanting down, so I'll let it break through a little bit. But if we can break above 1220, I'm going to get long gold. Our gold indicators, well, the top one's slightly bearish, the middle one's solidly bullish, but the bottom one's solidly bearish. Net, still pretty neutral for gold. Oil, this is, I think, one of the things that caused the CRB index of commodity prices to spike up, is oil got up to almost $77. Now, as you know, I've gotten much more bullish on the price of oil, but I think we're going to drift lower this week, just as a normal technical correction. And finally, for you freebies, Bitcoin did not drift low. Well, it drifted lower early, but then it kind of just went boring. Look at the range. The daily range of Bitcoin is basically 0. Purple Predictor has stabilized, suggesting that we can just stay in this trading range here for quite some time. If I had to really say which way it's going to break, I'd have to say it's going to break down, not break up. But for the short term, let's just call it a boring sideways market. All right, we've got some, well, we're finished with the September. We are doing another Option Success School coming up in November. We sold out the one here that's this weekend. I'm doing that event right now. We sold it out, so we've actually added another Option Success School November 10th and 11th. So if you're interested, let us know. All right, and don't forget, make sure you've gotten your free copy of the How to Profit from the Coming Financial Crisis special report. I will be doing a new edition of it in the next couple of weeks to update it. All right, that's it for me, freebies. Fantastic having you here. Don't panic with this price action at all. Fully paid up members, hang on just a second. We have an extra long version of Wall Street Winners. So hang on, fully paid up members.